Hey guys, Joseph Henson here with Henson CPA Group. I appreciate everyone that emailed in with their suggestions in the last couple of weeks. And this week, one of the things that people wanted to talk about was veterinary clinic succession planning, ensuring a smooth transition for your clinic's future. So why is succession planning important? Many owners underestimate the financial complexities of succession. Poor planning can lead to tax burdens, undervalued sales, or cash flow issues. A structured plan protects your wealth and ensures profitable transition. What does all this mean? What this really goes into is planning for a succession for who takes over when you retire, when you sell, when you bring in a new partner gets complicated. It can cost you money. It can make it where you don't have cash flow to pay your employees. It can lead to a huge tax bill if you're not proactive and do this in the right way. You want to make sure you always structure this in a way that is tax advantaged to help you spread this out potentially. So key questions to ask before planning. What is your financial goal for succession? Are you looking to retire? Are you looking to reinvest and build a new clinic potentially in another state? Are you looking to liquidate some cash and make it easier on you to have a lifestyle you really dreamed of but didn't always have? How much do you need from sale to maintain your lifestyle? If you're currently making $300,000 a year between your W-2 from your job, assuming you are an S Corp, and also between owner draws, the portion you get because you're the owner, what do you truly need to have that sort of lifestyle after your retirement, after you sell your practice? Are you structuring the sale to minimize tax liability? Is this an asset sale? Is this a stock sale? How much of this is really going to benefit you? Will your successor have financial backing to complete the transaction? A lot of clinics sell for several $1 million, especially large ones. Even a mid-size clinic, saying $750,000, will sell for over $1 million in general. It depends on several key items. Your successor has to have the right financial backing, whether that's cash, a bank loan, or owner financing. If you're willing to finance some of this for your successor, that is something that's possible. Never do 100% in my opinion, but that's just me. Determining the value of your practice. There's a lot that goes into this. This is going to be a very simplified explanation. So for some key valuation factors, revenue and profitability trends. What is your revenue and how profitable are you? What does that look like over the last 3 to 5 years? The market conditions and buyer demand. During some years, veterinary clinics are in more demand for private equity and buyouts than in other years. You need to see what it looks like in your area. If you have a lot of private equity coming in to purchase the veterinary clinics, you might be able to get a couple of them going back and forth. If you have no demand, your price isn't going to be as great compared to years where you're getting offers left and right, whether that's a corporate buyout, whether that's private equity, whether that's personal buyouts. It's always there. Client retention and goodwill. How many of your clients are truly going to stay if you sell your clinic? How much of that goes into goodwill? What is your clinic worth because you've built a brand? If you're the only veterinarian within a certain area, you have some goodwill there. There's not a lot of options. Real estate, equipment, and intangible assets. Do you own the real estate, or is this something else that the person has to then get a rent agreement on? The equipment, is this all fully paid off, or are you currently making payments on this? Intangible assets, client lists, goodwill, non-competes, these all go into it. One of the tips I always like to have is regularly update your valuations to maintain an accurate financial picture. If you're looking at your net worth, your valuation of your clinic does go into this. Transition structures and financial impact. There's really 4 or 5 of these, but I like to focus on these ones. A gradual buy-in, a family transfer, outright sale, or merger or corporate buyout. So let's start with the gradual buy-in. A steady income over time, reduced upfront taxes. So this is where you have a partner coming in, an associate vet, and they're like, hey, I want to buy you out. Okay, great. I would like to retire in 5 years. So my plan is going to be a 10, 10, 20, 20, 40, something along those lines. So you're going to get a little bit more on the back end, but you still start to give up some ownership. So first year, they give you $100,000. Second year, $100,000. The next year, 200, 200, and the additional 400 if you have $1 million valuation. This does help reduce the taxes because you're recognizing a sale as you go. Family transfer. This often involves gifting strategy and estate planning. This gets very complicated if you're trying to give your clinic to your next generation of veterinarians, especially if they're in your family. You have to make sure this is structured properly because it does get tricky. This does not just involve one CPA. This also involves attorneys. Outright sale, immediate payout, potential tax consequences. If you automatically get a sale, an outright sale of $2.5 million, you have to know what does this look like in your clinic and how are you going to absorb the tax? Because that tax bill is going to hurt. You're going to have capital gains and it's going to be 20% plus state. It can hurt. Merger or corporate buyout. This may yield a higher valuation, but has very little tax control considerations. You don't get a lot of sale if there's a corporate buyout. A lot of say if there's a corporate buyout. They're going to come in. They're going to look at your income statement. They're going to look at your balance sheet, and they're going to say, okay, these are items we need to add back in. You're taking way too much payout, or you're not taking enough payout. We're going to make an adjustment. We're going to do a portion of EBITDA, earnings before interest, tax, depreciation, and amortization. You have to be aware of this and make sure that you go in with a good representation to help you. Maximizing financial value before transition. You want to optimize your profitability, reduce your expenses, increase efficiency, and boost revenue. There comes a point where you can only cut so much. So now we start looking at how do we increase your efficiency in the clinic? How can you see more patients in the same amount of time? If you're seeing 3 an hour, how do we get you to 4 an hour? That's an immediate increase to your bottom line. That is going to help boost revenue. That is also going to show that you are able to scale. Strengthen your cash flow. We want to show consistent and predictable income streams. If 1 year you see a random $10,000 sale, that's not going to do a lot to move it. Now, if you see a $10,000 increase in revenue every single month, this is predictable. This is also consistent. We want to make sure that your income streams start to get optimized. You're not focusing on 100 different things. You're focusing on 10 or 20 different things, even go from 20 down to 15. But you have what you make and what you do well, whether that's surgeries, whether that's just spay and neuter, whether that's just general clinic vaccinations, but people know to come to you because you are consistent. You can implement areas for predictable income streams, like I've talked about before, with membership programs, cleaned up financial records. You need transparent accounting, and you need good financials to increase buyer confidence. If they have to make a ton of adjustments because your financials are hard to read, you will lose money. They're not going to feel great about this because they can't understand your financials very easily. You want to have financial records in a place for the last 3 to 5 years. They're always going to look at 2 years, potentially look at 3 years plus current year. We need to make sure that you have your financials in a place that they're not questioning everything. They compare year to year, and it makes it easier for them to understand where you are, where you've been, and where you're going. Increase practice desirability. Invest in technology. Invest in your branding and invest in patient retention. I've said it before, you can watch my other videos. When it comes to growth, it is easier to retain a current patient than it is to go out and get a new one. It will save you a ton of money. It will optimize your revenue spend or your advertising spend and make it so that you're not constantly just replacing and replenishing folks leaving. We want to make sure that it is easy to see growth. If you're gaining 2 new clients and replacing 1, that's not great growth. If you're gaining 5 or 6 new patients and replacing 1, that's great. You have 1 person leave compared to the 6 you brought in. That's okay. We're now going to maintain hopefully 5 of those 6. And that's how you're doing this. Investing in technology will make your practice more efficient, allowing growth. You can now get different things. If you're dictating in your clinic, you can get AI that will listen and dictate, take notes for you, and then you can have someone write those up if you don't like how it does. It's going to be a little bit manual, but it also optimizes what you're already doing. Your branding has to be on point. Having a clinic that doesn't brand well is hard. We have rebranded before just because we needed to. We want to make sure that who we are and what we do is reflective in our brand. And your clinic should do the same. You don't want to have a name that says surgery and you're not doing surgeries. It doesn't make sense. We want to make sure that your brand and your market flows and is easy to monetize. Common financial pitfalls to avoid. You will, if you're failing to plan for taxes, this is going to result in a huge unexpected liability. You need a CPA in your corner, a financial advisor in your corner that can help figure out what your financial impact is. Selling your clinic for $2.5 million and getting a tax bill for $700,000 is going to hurt. Yeah, you still have $1.8 million, but is there something you could have done? Is there something you could have structured that would have reduced that tax burden? Selling without a proper valuation, leading to underpricing yourself. You've been building this clinic for years. It's time to make sure that you know what your clinic is valued at before going in. Don't just let someone come in and say, I'm going to give you this much for it based on this. You can negotiate to have either you or the buyer or a combination do a true valuation on your clinic. Not preparing financial records, making the practice less attractive to buyers. I can't stress this enough. If you're still working off pen and paper for your finances, if you're just going based on your bank account saying, well, I had more money this year than I did last year, I must have done great, you will cut yourself short. This does not make it attractive. If your potential buyer can't look at your financial statements and say, here's what came from surgeries, here's what came from my general practice, here's the revenue that we made it in our pharmacy, it makes it difficult. If you're doing grooming, it should be broken out on your records. They should be able to see what you've been doing and go from there. Another pitfall is going to be assuming a successor can secure financing without verification. This can be a combination. They're going to need to see that your clinic is worth what you say it is. If they're getting bank financing, your bank is not going to, their bank is not going to loan 100% of that loan. You might have to figure out a way to help them with some owner financing, with some buyouts. It can get tricky, it can get complicated, but it can also be beneficial to make sure you get that sale. We want to make sure that's happening right. Well, as always, thank you guys for your emails. Thanks for your questions. Again, I'm Joseph Henson with Henson CPA Group. My email is on the screen. If you're looking at trying to figure out how to sell your practice in the next 2 to 5 years, reach out to us and we're going to be happy to help you and answer any questions we have. Other than that, I will talk to you guys next week and you have a great